Good afternoon, everyone. This is Brad Matheny again. I just completed part one of the why the Fed lowered rates, my opinion, and I'm trying to continue it along here. So understand that the Fed is acting in the best interest of the U.S. by engaging in a way as a lender of last resort or a manager of last resort related to global currency and economic pressures. So, we're going to maybe try to take a look at a few examples here, and try to pinpoint what's actually going on by taking a look at some of the world's markets. So, this is a US debt to GDP ratio. It doesn't go back very far, it goes back to 2019. This is weekly. I was hoping it would go back a lot further. But understand that we've seen these peaks and these, debt to GDP ratio. When we're up at these peak levels, this means we're pumping up a bunch of new debt. And then as we see a GDP increase, that debt level peak minimizes. As we go into new spending, debt levels go up. As we go into a GDP increase, debt levels go down. So you can see here that, historically, these low 19 trillion type levels are where we're at. Where we're at right now is a whole other story. Okay, we are in this. This is GDP to debt. So this is. I may have done it backwards. A GDP divided by debt. So yeah, as this increases, this is GDP increasing. GDP divided by debt. Yeah, GDP would be increasing as debt continued to spiral out of control. Now, in this case, this was COVID, the collapse in the markets. Okay. And what happened here is this is a scenario where GDP shot up and debt at the same point in time shot up down over here. So, as we've gotten now to this point, what this is telling us is that GDP has continued to climb. So, you will add US GDP here and move it to a lower, move to pane above. Okay, as you can see here, folks, the US GDP level here really fluctuated from an uptrend here from minus, well, this is now all in percent. Let's go to regular, that is, oops, I want them back. You can see that the GDP ratio, World Bank, US has continued to climb since COVID. We've gone from essentially 21 trillion up to, got to shrink this down, but close to 30 trillion, I would assume. Yep, 28 trillion, 27 trillion. So we're getting a big rally in GDP throughout this scenario while debt is increasing, okay, or sustaining itself moderately. This is going to be a scenario where we're going to climb out of this, where debt to GDP will be a much smaller amount as GDP continues to increase. And that's what I believe is likely to happen, is that we're going to continue to see GDP increase compared to debt, which what will happen is that would, if GDP goes up and debt stays rather minimal, this is going to trail downward, like I suggested here. And why is that going to be the case? Well, the US economy is continuing to perform extremely well. And when you take a look at the measures that have been put in place with regards to how the Fed has weakened money supply. Now, this top chart here is a little custom money supply, money function scenario. And I showed this way back over here in beginning of 2024. The markets are holding up well. Gold is reacting to fear related to a global contagion event. but money supply, money function throughout the world is contracting quite extensively. Okay, we are now in a very solid downturn. We're way back over to these levels that we haven't seen since 2018. The entire excess phase is kind of peaked out and rolled. And what the Fed wants to do right now is the Fed wants to create a breathing room. It does not want to watch this collapse. Okay. It does not want to watch this collapse. What it wants is a breathing room. It wants this to move into sideways trading, build a base, and then roll back up out of it. That's why the Fed is making a move. They realize that they have substantially weakened money flow and money function throughout the economy, while gold is anticipating, as you can see here, is anticipating a potential contagion event that may take place. So that is related to global credit debt market concerns with regards to currencies. And that is why when we come back over here and we start taking a look at, I will get rid of this and this, and we start taking a look at, for example, these are some of the biggest economies on the planet. Okay, let's try to find Hang Seng Index. Hang Seng Index, we'll pick this one. Hang Seng Index over the last 14, 15 years here has considerably weakened. Let's go to monthly. So this is the time that I was down doing business in Asia, right in here. Spent a lot of time in Southeast Asia at that time during the global currency crisis. And you can see how China has blown up. I mean, literally from these early 1990 areas, 1,000% increase in their stock market over the last 25 so years. Okay, but you can see how it has weakened considerably. And this reminds me of the Japanese market in the 80s, right here. That's what this reminds me of, is that China went through or is going through something very similar to what happened in Japan, roughly over in this area. Go away. Roughly over in this area, basing and building some growth, and then peaked. And now we're rolling through this sideways channel, eventually coming to some base way over here. And remember that time frame from peak to base from 1990 to 2009, you got to figure that out. That's 19 years. So we come back over here to the Hang Seng Index, and I would suggest that what we are looking at here is a peak. And then I would suggest that we are looking at a continued meltdown. Remember, we're in that early stage, so we'll get a bounce. Maybe not quite like that, but we will get a bounce and then roll into some weakness, probably into this area, eliminating still another, call it where it's at roughly here, another 30, 40% of the downside on the Hang Seng Index. And I believe this is going to be a global event. I believe you're going to find, in fact, let's find the KLSE, which is the Malaysian Stock Exchange. I spent quite a bit of time over there. Yep, here we go. I was in the Malaysian stock market and involved in the Malaysian economy back over here. And this was a horrible time for the markets back over here in 97 and 98. But still, look at this rally. This is a global rally that has taken place. They've moved up 200% in the Kuala Lumpur Stock Exchange. And remember, Malaysia's GDP is very minor compared to the US markets. But still, the rotation out of this market from basically 2022 onward precludes essentially that this is going to continue to move downward and again try to base and then maybe move into some upward trending out into 2040. And I can draw this over and over again. Let's try to find Italy index. Looks like there's the Italy 40. Here we go. Okay, so here's the top 40 for Italy. Doesn't have much as far as data, but you can see this rally phase here rolling into this peaking pattern. And again, I would say this looks, quite similar actually to the European market or to the US market, except that it hasn't had such a big rally phase. But I can see some more similarities in this than I can in the other indexes. But I would still argue that these indexes will weaken into 2030, 2035 and begin to roll out of this basing model around 2030, 2035. So I may have drawn this a little bit more narrow. It might actually be more along the lines of this. But this is the time frame that's required to unwind the global excesses. And I believe it's going to be coming from all levels of global economy. I believe that all global economies are going to revert back to the mean over the next 7, 8, 9 years, which is why the Fed will likely have to manage this weakening economy, this potential for a global credit debt crisis. And in my opinion, if it is a measured move, if it is not a collapse, let's go back to the Japanese. Well, actually, let's take a look at the Germany. Okay, so Germany here really taking off, as you can see, and there's the big move here. You can see the pullback that occurred after 2000, and then you can see the pullback here in 2008-9. This is mirroring along with the U.S. markets quite well. We're moving, rolling around just off of new highs. But again, Germany, I would say, would be fourth on the list, probably above China, for continuing with the U.S. markets. Now, do I believe Germany will contract? Possibly. I could see a moderate contraction taking place if the U.S. markets and the other markets roll into some contraction. Otherwise, no, I don't believe so. I believe Germany is a dynamic economy leading the European Union. And I mean, they're basically second, I believe, on the European Union list in regards to economic activity. So no, I don't believe it could do this unless we see some broad global type of contagion event. More than likely, it's going to rally upward. And again, but we have other symbols, other U.S. markets that are contracting. And like I said, not other U.S. markets, other global markets. And that's what I really believe is going to be the case. Now, the Japanese yen, like I said, I do believe it will roll. I do believe that it will meander sideways and downward. I think that's going to be the case. And I think what's going to happen is a lot of these global central banks are going to have to, believe it or not, attempt to raise rates into a relatively strong US economy, relatively strong major market economy. That includes the US, that includes Japan, that includes Europe, Great Britain, and possibly Germany. And I believe they're going to have to raise rates to stay competitive. Otherwise, they will suck capital away from their markets, making it harder and harder for them to service their debt loads. And that's going to be what's going to take place over the next 3 to 5 years. Basically, money is flowing into the US and the major, more dynamic economies and away from these weaker currencies and weaker economies. which is setting a dynamic that until we reach that what I call an organic bottom. So I'm going to come back over here and show you. I highlighted this in the last video. Until this mode ends, where money is flowing out of global economies and into Great Britain, Japan, US dollar, and we can add Germany to the list, it looks like, maybe even Italy. But until we move into an organic basing pattern, we are going to see that dynamic continue to play. Now, what does a dynamic basing pattern look like? It basically comes to a point where all markets have reached a point of equilibrium where they begin to rally on their own in an organic mode, meaning without moderate stimulus, and continue to grow. And that, I believe, as I've drawn here, maybe not in this manner, maybe not this deep, is going to happen right over in this area, basically right in this area. 2027, 2028. And that is why the Fed is doing what they're doing right now. They're trying to create a balanced equilibrium for global market growth, which, if my analysis is correct, I will show you what I believe is going to happen, is that we will enter a new parabolic growth phase, peaking, and then rolling into some major potential crisis mode over here. So ultimately, guys, and I've shown this to you on dozens of other charts, the Fed is making a move right now to provide, to act, basically balance. The Fed is on a tight wire, a couple thousand feet above the ground. And what they're doing is they realize that in order to alleviate U.S. economic inflation pressure, they had to raise rates, and they did that. And they left the rates in place no matter what risks were in place for global markets. But now that they're seeing the money supply, remember, we come back over here, money function and money supply is deteriorated considerably from back over here when they were raising rates. Now we're way back down here, and now we're looking at a very low level. And what they want to do is they want to turn this around. They want to get this to base, bottom, and roll back upward, which again, 2026, 2027, right in this area here, we should be looking for some sort of an upward shift in the global markets. The US markets will probably continue to shift upward for the next 48 months or so. But the global markets were really base and bottom in this area to late 26, early 27, and begin to move higher. And that's where we move into this really big growth phase right over in this area after it bases. And this is why this is the biggest opportunity of your lifetime. This is going to be the major contagion crisis event right up here. This is the big one. That's when everybody's going to freak out. And I don't see the markets having any major crisis event for about the next, let's count them out, 24, 25, 26, 27, 28, 29, 30, 31, 32, roughly 7, 8 years. And that puts us right over here in this area. This becomes the early stage crisis event. It could happen somewhere over in this area. Don't know exactly where. I'm guessing 2031, 32, 33. But this is the rally that everybody should be anticipating. And I know this is going to get lost in all the other crud that's out there. But again, pay attention to what I'm telling you. I've been telling you this for 3 or 4 or 5+ years. The market's going to keep going up. Now, granted, some markets are going to keep rotating around and we're going to get some pullbacks, but this is what you're looking at 7, 8, 9, 10 years out in the future. Okay. And that's why the Fed made this move, to give the global markets room to rally. Okay, guys, that's it for now.